Hello, I'm Kevin Miller, CEO and Portfolio Manager of the E-Valuator Funds. Today we're going to talk about the the E-Valuator Funds performance and the market performance, looking back at calendar year 2020. We're going to look at the first quarter of this year, and we're going to kind of give some perspective on where we see things going in the last half of 2021. It's the morning of June 15th, and so we expect this afternoon Chairman Powell with the Federal Reserve will provide some impactful information with regard to where they see interest rates going. So it's going to be interesting to see how the last half of this month plays out. But to get started, there are two elements that influence the performance of the portfolio. One is the underlying investment selection and monitoring and replacement of bad investments. And the other element would be asset allocation. With regard to the investment selection, we use the E-Valuator software as our analytical tool to choose what investments are good and what investments are not acceptable. And the one thing that we know and we feel very strong about is we are comfortable that we will always be using some of the best money managers out there. So the use and selection of an investment manager, we always, by way of using the software, we're always going to end up with an investment manager that's performing very well relative to their peers. The E-Valuator software was recently awarded in 2020 as the best investment analytical tool for 401ks and IRAs. And that award came to us from wealthmanagement.com, and it's a relatively prestigious award in our industry, and we're honored to have it. But I think what that does is that validates that our belief in this system is recognized by our peers as well. The other element that impacts the performance of a portfolio is asset allocation. And asset allocation, that means how much money are you putting in stocks, how much in bonds, of what type of stocks, what type of bonds, how are you allocating that money? So when we do this, what we do is we create a rules-based approach. And the reason we use a rules-based approach is because it removes emotion. And emotion can be one of the most destructive components of asset management. So you want to manage money based on a set of rules. You need to look into the future. So you're allocating assets based on where you see things going or think things may be going. Our outlook is 9 to 15 months down the road. So today is June 15th. We're looking, first quarter of next year to middle part of next year at this point in time. Allocation adjustments between fixed and bond or fixed income, which would be bonds and stocks. That's happening all the time. And then we also rebalance. So all of those elements are combined into asset allocation, and that's what's driving the performance of these portfolios as well. So if we look at 2020, the year started off with the S&P 500 at about 3,200. It went up to 3,386 on February, dropped by about 34% on March 23rd, which was the shortest number of days from market peak to bear market, which was more than a 20% sell-off in history. It only took 21 days. And then it recovered after that. And it ended up positive 16.26 for the year. So how did the E-Valuator funds perform? Well, let's look at the very conservative. The first thing we'll point out is the stock allocation range. This tells you the minimum and the maximum this investment will have in stocks at any time. So the very conservative could have 0% in stocks, or it could have up to 15% in stocks. This shows you the category that Morningstar is comparing this to. Morningstar does not have a 0 to 15% equity category, so Morningstar puts this investment in the equity allocation category with investments that could have anywhere from 15 to 30% in stocks. So this one really isn't matched up real well with their Morningstar peers. There isn't anything we can do about it. It is what it is. This investment's performance for 2020 was 8% compared to 7.29. So it outperformed the average of its peers by 110%. Next is the conservative investment. Now this investment, which will always have at least 15% in stocks, never more than 30, it is appropriately aligned with its peer group. Morningstar has appropriately established a peer group that mirrors the asset allocation of this fund. This fund outperformed its peers by over 150%. It posted an 11% return, and according to Morningstar's average for their peer group was 7.29. The conservative moderate investment will have 30 to 50% in stocks. It was up 12% compared to 886, outperformed by over 140% above the average of its peers. The moderate will always have at least 50% in stocks, never more than 70. It posted a 15.8% return, which is 135% better than the average of the peers. The growth was 70 to 85% in stocks, posted 20% gain, outperformed the average of its peers by almost 150%. And then the aggressive growth will always have at least 85% in stocks, posted a 19.89% return for 2020, outperformed the average of its peers by 130%. So when you look at how much superior performance these funds generated over the average of their peers, that gives us comfort that our system works, that our evaluator tool is selecting good managers, and that our rules-based asset allocation methodology is working well for our shareholders. Now let's look at how the S&P 500 has done year to date through the end of May. So if you just look at the first quarter it was up 5.77%. We put these bars over the tops and the valleys because to show you just how range bound the S&P 500 has been. It hasn't made any dramatic moves up, hasn't really made any dramatic moves backwards either. So first quarter is up 5.77. So let's look at what happened in that first quarter. Well, in January, if you recall, on January 6th, there were riots in DC. We had fence surrounding the White House and the Capitol, never seen that before. And then the new president processed more executive orders in the first 2 weeks of office than any president in history. So there's a lot of uncertainty going on. What direction are we going to go as a country? Uncertainty can impact the stock market on a negative way, in a negative manner. And we felt that could be the possibility toward the end of January, that there'd be too much uncertainty and the market would pull back. But the thing that's kind of offsetting that uncertainty is the Federal Reserve's pumping and creating of currency and liquidity in the marketplace. And the expansion of currency or liquidity is like candy to the stock market. When there's a lot of liquidity out there, the market typically does really well, and it may not be a sustainable growth in the stock market. It may typically is more short-term based, but it does help offset any uncertainty that's being generated. So at the end of January, our response was we chose to reduce our allocations in stocks and to begin preparing for inflation. And we were looking, out, like September, mid to late 2021 is when we were thinking inflation would start showing up pretty significantly. So how do we make an investment more defensive? Let's take the 50 to 70% equity allocation. So we'll always have at least 50% in stocks, but never more than 70. Always have at least 30% in bonds, never more than 50. So if we were going to be defensive, we would have that allocation in stocks down around 52, 53, maybe 51%, and we would elevate that allocation to bonds up to 47, 48, or 49%. To contrast that, if we wanted to be more growth oriented like we were in 2020, we would have had that equity allocation much higher, like 68, 69, or 70%, and we would have had the bond allocation much lower, like 30, 31, 32, 33%. So that's the equity, that's the allocation adjustments that we're constantly making inside each of these investments based on what we're seeing and the indicators that we're following with regard to where the market we think will be going. I also mentioned we started getting ready for inflation. So what is typically a good hedge against inflation? Well, precious metals, commodities, they typically do well in inflationary times, because what happens is during inflationary periods, the strength of the dollar gets weaker. So things that you purchase, like commodities, they typically go up in value relative to the weakness of the currency. So we identified 3 precious metals that we thought would have a good opportunity of showing some growth between now and the end of the year. Gold, silver, and copper. Gold and silver, definitely precious metals. Could we possibly go back to a gold-backed currency? It's a potential. Silver is also used in industrial use. And then copper, with all of the push toward electronic cars and the housing boom and all the wiring that is required inside a home, we see copper use not dwindling, but only expanding in the near future and the distant future. In fact, Goldman Sachs agrees with that. This is a chart that shows copper use and then their estimated or projected use of copper post 2021. So it goes back to 2011, excuse me. And you can see that in 2021, where they start projecting, you can see that copper usage is, according to their anticipation, does not look like it's going to diminish in the future. And so that should be a good opportunity for us to keep pace and maybe even outperform an inflationary period. This page shows us how the investments have performed just in the month of January of this year. And you can see they're identified by their name and asset allocation range, January performance relative to their peers. And you can see that January is a very good month for the investments relative to their peer group. And so the asset allocation that we took, that transpired in January, was very positive for the outcome on our shareholders' behalf. So then March and February came, and we saw some things happen that we were not expecting. But before we go ahead and look at that, the first thing we need to note is that the inverse relationship between a bond's performance and interest rates. And it's so when interest rates increase or rise or go up, bond prices will decline or go down. On the other hand, when interest rates decline or go down, bond prices will increase. So if we see interest rates going up, we know bonds are not going to do well. If we see interest rates going down, we know that bonds are going to start performing quite well. Well, this is the chart of the 10-year Treasury note yield, and this goes back to January of this year, and it goes to the end of March. And so you can see that on February 1st, the 10-year Treasury was at 1.078. That's the yield that it was generating. That's the interest rate it was crediting. Fast forward to the end of the quarter, that went from 1.078 up to 1.745, a 62% increase in 2 months. That was not expected. And going back to the inverse relationship, when interest rates rise, bond prices decline. So what did this increase in interest rates do to bonds? Well, this shows you all of the bond categories that Morningstar tracks, okay? And the number to the left just tells you how many investments are in each category. So there's 237 ultra short-term bond funds, okay? This shows you the return of each category. That's the average return of each category for January, February, and March of this year. Well, you can see that March, there were a lot of bond categories that were negative. Likewise with February. Likewise, January had, more probably negative then were positive. So the increase that we're seeing here just from February to the end of March shows up when you look at the February and March bond performance. So when we adjusted the allocation of our investments to reduce our stock exposure, put a little bit more in bonds, and we did that toward the end of January, well, that didn't work out so well for the next 2 months. Likewise, we started actively allocating money, a small amount, but we were allocating a small amount into inflation protected investments. And so this shows you what the price of gold had done for the first quarter of this year. And if you go back to February 1st, when we just kind of started allocating money into precious metals, you can see that gold went from 1863 down to 1715. So it had an 8% decline. So that asset allocation that we did, it had a short-term lag on our performance for the first quarter, even though our January was so strong. But the question is, were we right to begin preparing for inflation? Was that a smart thing to do? Well, if you go back to May of 2020 and compare some of these things to what the cost was a year later in May of 2021, you'll see that gasoline has gone up by 172%. Lumber has gone up by over 400%. In fact, if you were to take $50,000 back in May of 2020 and build a 2,300 square foot home, you would have been able to build 10 2,300 square foot homes based on how much money how much lumber you could have bought with $50,000 in May of 2020. Fast forward to May of 2021, using the same dollar amount and the same size of home, you'd only be able to build just a little over 2 homes. So that just shows you inflation. That shows you where in May of 2020, you could have built 10 homes with $50,000, but in May of 2021, you can only build 2 because the price of lumber went up so much. Now, lumber's starting to come back as of recently, but it's still inflationary. It's still much higher than it was a year ago. What's the average cost for a home in 2020 was $283. In May of 2021, it was $320. It went up 113%. Coffee up 153%. Wheat 141. Corn, copper. So yes, we should be concerned about inflation, and we are experiencing it. It's just that the Federal Reserve is not acknowledging it yet. Maybe Chairman Powell will this afternoon. I'm not sure. But there's some things happening that haven't happened for a long time. And when that takes place, that gets everyone's attention. In April, core CPI, which is, the consumer price index, that's an index used to measure inflation. It has its largest 12-month increase since January of 1996. So you got to go back to 1996 to see the core CPI jump as much as it did in April of this year. The month-over-month jump was the biggest since 1981. And then if we look at headline CPI, that soared by 5% year over year. That's the highest level of inflation since 2008. So go back, 12, 13 years. That's what this chart is showing, is how that headline CPI is just shooting up. And that's concerning because if you look last time it was at this level, it was 2008. And we know how things performed in 2008 and 2009. So these are eye-catching, concerning developments. Not saying something terrible is going to happen. It's just that we need to acknowledge where things are at with regard to our asset allocation, investment selection, and asset management. So as of the end of March, how did our funds perform? This report, we're showing you a couple more time frames. We're going to show you the 1-year return right here. We'll show you the 5-year versus the category average, and then the return of the fund since inception. From a regulatory perspective, we need to show you all 3 of these as of the most recent quarter end. So that's why you're seeing this information. So you can see the very conservative 1-year return was 15.7 compared to 17.24. Again, this fund doesn't match real well with its Morningstar peers, but we have to compare it to something. The conservative investment, which does match very well with its peer group as far as the equity allocation limits, outperformed by 23 to 17. The conservative moderate outperformed by 30, let's just call it 32 to 26. The moderate outperformed by 42 to 36. The growth outperformed by 52 to 46. And the aggressive growth by 59 to 58, we'll call it. So again, consistent performance relative to the peers. That's what we're looking for. And so we're hoping to continue to extend that throughout 2021. These are the parameters that we need to disclose to you with regard to risk investing in investments such as these, and that they're not FDIC insured. They could lose their value. Their value could go up. Their value could go down. You should read the prospectus carefully before investing. So these are just some of the disclaimers that we need to make available to you. Let you know that the performance, that data that we have is provided to us by Morningstar. Past performance does not guarantee future results. All those good things that you need to know as being a wise investor. So let's look at what could be a possibility or a probability for the remainder of 2021. Is it possible the stock market continues its relatively consistent climb? Yes. What would need to take place for this to happen? Well, the economy would need to continue to open up. The stimulus checks from the government would need to be discontinued so people would go back to work. We need to reestablish the supply chains. The supply chains are broken, and I think they will be reestablished when people do go back to work that are staying home right now, who are receiving stimulus checks. Interest rates need to remain relatively low. Inflation needs to be manageable. And then the substantial amount of investable cash, liquid cash that's out there needs to be deployed into the economy and into the markets. By liquid cash, what we're talking about is there's about $4.3 trillion of cash that's sitting on the sidelines that is not actively invested in stocks or bonds. This is per JP Morgan. So that's a staggering amount of cash. So if that amount would just get reinfused back into the economy and into the markets, you would see that being enough energy to propel the stock market for a considerable period of time. The other thing that we think could help be a positive for the market is the fact that there are over 9 million jobs available right now. And you can see, going back to 2001, we've never seen a period where there's been 9 million job openings. And, you go everywhere, people are trying to hire, they're paying people just to come in and do an interview. There's all kinds of openings for people of a variety of skill sets. So this is a good number, because as we get people back into the workforce, you're going to end up seeing the supply chains become more efficient, the supply itself being elevated, and that will get to a point where it's going to meet or exceed demand. So if we look at the first 5 months of 2021, again, the first quarter was up 5.77, relatively range bound. It ended, the first 5 months ended up 11.93, but again, the second 2 months were relatively range bound again. We haven't seen a sizable incline or decline in the market up to this point in time. So is it possible the stock market could experience a short-term pullback before it continues to grow? Yes. What would initiate a pullback? Well, if they're talking about increasing taxes, they're talking about increasing capital gains tax from 15 to 20%, depending on what your income level is, up to over 40%. If inflation and inefficient supply chains continue to linger, that could be reason enough for a pullback in the stock market. Global unrest, political turmoil, the outcome of, some states are going through audits to see if the vote count matches to what an audited vote count matches. And let's say that those do not match, and there's a disruptive difference between what is audited and what was originally posted. I mean, our country, quite candidly, has never gone through that before. How will we respond? And I remind you, the market doesn't like uncertainty. Would that create enough uncertainty? And then we need to identify the amount of debt that we have as a country. And if we, went to and look back at our history and with our debt, back in 1973, that was when President Nixon took us off the gold standard, and our currency was no longer backed in the same manner as it was prior to 1973. At that point in time, we had $458 billion in debt as a country, which was 32% of our gross domestic product. So of all the product that we created, goods and services, 32% of our production we carried in debt. Okay. So let's fast forward to this century. 2001, we went from 458 billion in debt to 5.7 trillion in debt, which now makes up 54% of our gross domestic product. If you go down to 2020, you can see that we now have over $26 trillion in debt, which makes up at the end of 2020, 128% of our production. And you can see that debt as a percentage of GDP just grows. It just continues to grow. And here in 2012, we actually had the equal amount of debt in our country as we had production of goods and services. This is a website you can visit. It's the usdebtclock.org. Right here, it shows you the amount of debt that we have, and these numbers are constantly moving, unfortunately, in the wrong direction. That they're constantly increasing. And then this shows, as of the day I did this screenshot, that our debt as a percentage of GDP was just a little bit shy of 128%. But there's a lot of good information here, not necessarily positive information, but it's very interesting to look at this and see where we're going with regard to tax revenues, the debt. You can see our total unfunded liabilities, the amount of liability per citizen. So these are things that we have to track, because this is not a sustainable event. I mean, something is going to need to be restructured, whether it's a currency reset or what, but something's going to need to transpire so we can stop this this increase that we're seeing, this continually steady climb of debt as we go from year to year to year to year. That needs to be addressed. I mentioned $1 trillion, and we throw that around like it's a nickel. I can't really get my mind around how much money is $1 trillion. So what I did is I said, how many years would it take to pay off $1 trillion of debt if we paid it off at $1 a second? So every second we just paid $1, and we weren't paying any principal or any interest. We're just paying the principal. Well, there's 365 days in the year. There's 24 hours in a day. So that means there's 8,760 hours in a year. There are 60 minutes in an hour. So that means there's 525,600 minutes in a year. And so then we need to figure out how many seconds in a year. Take that times 60. So there are 31,536,000 seconds in a year. So we would take this number and divide it into 1 trillion. And that would tell us that if we had $1 trillion of debt and we were paying it off at a rate of $1 per second, it would take us 31,710 years to pay off just the principal. This is why we need to address what is happening with the debt. We can go on for a prolonged period of time, but at some point in time in the future, whether it's 5 months, 5 years, I don't know how long, but at some point in time, this is going to have to be addressed, and it's going to be addressed, and it can be addressed in multiple ways, but this is something that we just can't ignore. Now, the only good news about this is that we're not alone. This is a chart that shows all the countries in the world, and it shows the percentage of their debt to GDP. The dark green ones have less than 10%, so they have very little debt. The dark red ones have over 200%. So it kind of starts with the green on the outside, and then as you spiral in, you'll see that the percentages increase. Here's the USA. At the time that they printed this, it was 133% debt to GDP ratio. But you can see there's countries like Greece at 210, Japan at 257. You'll see France is in here at 115. The point I'm trying to make is it isn't like the United States is the only country that has a lot of debt. And that's what I'm telling you is that I think the whole system needs to be adjusted, because it's been almost 50 years since we went away from the gold standard, and this is what we have as a result of this. So the playing field that we're playing on right now needs to be changed to some extent. So what would be our outlook? Do we feel it's more probable that we're going to see continued growth in the stock market or a short-term pullback? We feel it's more probable that we're going to see a short-term pullback between now and the end of the year. We're not saying it's going to be a long-term event, but we could see something happening that would pull the market back, primarily due to just uncertainty until we saw what was really going on, and we understood that there was remedies in place to fix whatever the issues were. This is a great chart from JP Morgan. It shows, the gray bar shows the S&P 500's return for every year going back to 1980. The red dot below shows how much of a sell-off the stock market had at any point throughout the year. So the average intra-year drops, the average decline throughout the calendar year going back to 1980 was a 14% drop. Okay. However, the market was up 31 out of 41 years. So even though there was an average of a 14% drop, the stock market still ended up with a positive return. If you go out here, now this is as of May 31st, year to date, we're up about 12%. We've had about a 4% decline so far through the month of May. If you look at the amount of declines that have customarily happened, there are 23, going back to 1980, there are 23 23 years where the market declined 10% or more at any point in time during the year. And out of these 41 years, there's only 3 of them where the market declined 4% or less. 1995, I believe that's 2017, and then now. So this is a reason why we feel probability is on our side, that we'll see probably a 10 to 15% pullback between now and the end of the year. Is it possible we won't? Yes, it's possible we won't. But we feel that based on all the uncertainties that are going on out there, that we could see a pullback, and then at that point in time we would redeploy more of an allocation into stocks to take advantage of those cheaper prices. So our outlook for 2021 is, the probability of that. We do not expect this to be prolonged because consumer demand is going to be strong. We're going to have the improvement of workers re-engaging the workforce. With more people working, the supply chains will improve, which will elevate our supply to meet our demand. We think inflation may spike, but we don't expect it to be sustainable as supply chains improve. And then uncertainties over reforming the tax system, well, we'll know what's going to happen. We'll know whether these bills pass or not. If they do, we adjust accordingly. If they don't, we adjust accordingly. So this is kind of where we're at right now. So what we're going to do is we're probably going to maintain a more neutral allocation with our investments. And by a neutral allocation, what we mean is if we are currently, or we were a little more defensive, to become more neutral, we would move the allocation, for instance, in this 50 to 70 illustration, we would move the allocation more halfway between the minimum and the maximum stock allocation. And that's pretty much where we're at right now. I would say we're just a little bit below that. So like the 50 to 70% allocation, halfway would be to have 60% in stocks. We're probably at about 58 to 59%. And then likewise the bonds, we're a little bit, just slightly heavier in bonds. The bond funds have done very well in April and May because interest rates have started to decline again. So it's a long road. We don't measure it week by week or month by month, but I wanted to let you know kind of where things were standing with our investments. Once we see some of these items shake out, some of these items, with regard to taxes and inflation, and if there are going to be audits and of elections and what that's going to mean to, going forward. Once those things get shaken out, we see this thing, the economy, doing very well for a prolonged period of time. So with that, I want to thank you for taking the time to listen and to watch this. And please feel free to reach out to us and ask us any questions if there's some things that were mentioned here that you want some more follow-up on. Thank you very much.